If you think markets are driven by earnings, you are already standing on the wrong side of the gate. I have spent most of my life watching people study businesses, study management teams, study margins, study quarterly reports, and then lose money anyway because they never bothered to ask the only question that matters when the pressure rises. Who controls the gate through which liquidity enters and leaves the system? That question sounds abstract until the day it stops being abstract and starts deciding what your house is worth, what your retirement account can be sold for, whether your employer can refinance its debt, and whether the Federal Reserve can still rescue a market that has grown addicted to rescue. I want to tell you something as plainly as I can. The danger in front of you is not just that China is angry, or that tariffs are rising, or that diplomats are performing for cameras. The danger is that one of the largest economic powers on earth has concluded that the gatekeeper of the global financial system cannot be trusted. And once that conclusion hardens, the whole architecture of valuation starts to shake. For decades, the arrangement was simple. America issued the reserve currency. The world sold into the dollar system, saved inside the dollar system, borrowed inside the dollar system, insured itself through the dollar system, and when panic came, ran back into the same system because it was still the deepest gate in the world. That arrangement created a habit in investors. You came to believe that if America spent too much, the market would absorb it. If the Federal Reserve made a mistake, it would later reverse it. If yields rose too far, somebody large and foreign would still buy the paper. If a crisis appeared, the old gate would open wide enough to save you. Habits become cages when the world changes and your mind does not. What China appears to have understood, and what too many American investors still refuse to stare at directly, is that reserves inside another sovereign S system are not just assets. Under the wrong geopolitical conditions, they become hostages. Once you have seen reserves frozen, access weaponized, payment rails politicized, and sanctions turned into financial artillery, you do not look at Treasury paper the same way again. You call it safety, a strategic rival calls it vulnerability. That is why this story is bigger than a tariff dispute. What is taking place is a deliberate effort to reduce dependence on the dollar gate itself, not with a theatrical press conference, not with a single dramatic liquidation, but with the kind of state behavior that matters far more. Quiet repositioning, gold accumulation, bilateral currency arrangements, commodity settlement outside the old lane, parallel infrastructure built slowly enough to look incremental and steadily enough to become structural. Fay Falocite, Fay Turn, 48 File, 0 Fay. Most people miss structural change because they are trained to react only when they hear a loud sound. I have made a lot of money in my life by caring about the floorboards before the ceiling falls. If a country the size of China decides that dollar reserves are not a pure asset but a strategic liability, that is not a portfolio tweak. That is a national balance sheet judgment. It is the difference between living in a house and quietly building another exit because you no longer trust the front door. That is why the gold buying matters more than the gold narrative. I do not care whether some television guest thinks gold is old-fashioned. I care what a central bank does when it wants reserves that cannot be frozen, sanctioned, diluted by someone else, fiscal panic, or shut off by political hostility. Gold is not being accumulated there as a clever short-term trade. It is being accumulated as gate, free collateral. Fay Falocite, Fay Turn, 48 File, 0 Fay. I also care about direction more than headlines. Too many investors ask the wrong question. They ask whether the dollar is being replaced tomorrow morning. That is a childish question. The right question is whether a larger share of trade, reserves, and strategic trust is being rerouted over time. If the answer is yes, you are not looking at a tomorrow problem, you are looking at a repricing path, and paths are where fortunes are made and destroyed. The second thing most people do not respect is that systems do not break only when they are attacked from outside. They often break when pressure from outside meets weakness already inside. That is where this becomes dangerous for America. If you are confronting this challenge with a balanced fiscal position, conservative corporate leverage, low refinancing needs, soft valuations, and a Federal Reserve with clean room to cut rates, I would still pay attention, but I would not be speaking to you with this much urgency. That is not the world you live in. You live in a world where the United States needs to issue enormous quantities of debt into a market that has already started to question who the natural marginal buyer is going to be. You live in a world where one of the largest historic sources of demand is deliberately reducing vulnerability to the very system supplying the paper. You live in a world where the supply of treasuries is climbing, While the emotional certainty surrounding demand is shrinking, Fay file site Fay turn 48 file 0 Fay, you do not need a PhD for what comes next. When supply rises and structural demand weakens, yields go up. When yields go up, everything priced off the so-called risk-free rate gets revalued. Stocks, real estate, private equity, corporate borrowing, venture, fantasies, all of it. Fay file site Fay turn 48 file 0 Fay. This is where ordinary investors make a fatal mistake. They think in compartments. They think China is one story, bonds are another story, tech multiples are another story, real estate is another story, and their own job is something else entirely. I do not think that way. I think in gates, if the cost of moving through the money gate rises, then every dependent structure behind it feels the force. Your mortgage market feels it, your employer-s debt stack feels it, a private equity-backed services company feels it, a retailer living on thin margin feels it. A media business that borrowed cheaply in the zero-rate years feels it. A commercial property portfolio waiting for painless rollover feels it. The middle tier of corporate America feels it hardest because it is large enough to be leveraged and not strong enough to be untouchable. Fay file site Fay turn 48 file 0 Fay, that middle tier is where a lot of damage hides before it becomes visible. The big glamorous names are not the first thing I look at in a tightening gate environment. I look at the companies that borrowed at 4 and 5 and now must refinance at 8 and 9 while revenue growth softens and customers themselves become cautious. That is where the mathematics stop being polite. A 1-point change can be managed. A multi-point reset on a weak business model is not a reset, it is a verdict. Fay file site Fay turn 48 file 0 Fay. Most people imagine financial crises as dramatic revelations. I usually see them as slow suffocations, a little more interest expense here, a little weaker consumer there, hiring freezes, delayed orders, widening credit spreads, lower multiple tolerance. A few management teams suddenly talking about discipline, a few lenders suddenly acting like lenders again, a few assets that were supposed to be liquid discovering they're only bids at insulting prices. That is how the gate starts to close. Then comes the psychological damage, and most people underestimate that part because they still think finance is mostly about spreadsheets. It is not. Finance is a machine for turning belief into price and price back into belief. George Soros called attention to reflexivity. I would put it even more simply for you. When prices fall in the right places, the fall itself changes behavior. People pull back, lenders tighten, employers delay, consumers lose nerve, revenue disappoints, debt feels heavier. More prices fall. What looked like a market issue reveals itself as a confidence tax on the real economy. That is the doom loop. And once it starts, you do not get to debate it like a podcast topic. You live inside it. Fay file site Fay turn 48 file 0 Fay. This is why the Federal Reserve matters. But not the way the average viewer thinks it matters. For 25 years, investors were trained to worship a single hidden superstition. No matter what goes wrong, the Fed can reopen the gate. In 2001, it cut. In 2008, it flooded. In 2020, it detonated liquidity on command. Each rescue taught the market the same lesson. Be aggressive, be early. Own the risky thing, the adults will save the room if it starts to burn. That lesson was profitable. It was also morally corrupting. Because once you believe somebody else must eventually reopen the gate, you stop respecting valuation, leverage, and fragility. You start behaving like a tenant in a building you think the government will always rebuild for free. Now the trap becomes clear. The Fed is not operating in a world of clean disinflation and endless credibility. It is operating in a world still shaped by deglobalization, structural fiscal excess, energy constraints, labor friction, and political pressure. If it cuts too fast into renewed weakness, it risks reigniting the very inflation that already damaged trust. If it stays tight, the refinancing pain gets worse. The old playbook is not gone, but it is no longer clean. And a market priced for clean rescue is a market priced for disappointment. Fay file site Fay turn 48 file 0 Fay. That is why I want you to understand the deepest part of the threat. It is not that China alone can destroy American capitalism. It is that China is applying pressure exactly where America's self-inflicted fragilities already sit. That is what makes the setup dangerous. China also has its own problems. I do not romanticize them. Their property sector has been a slow-motion demolition of confidence. Developer balance sheets are impaired. Local government finances are under strain. Household trust has been damaged. That matters because a deflationary contraction inside China does not stay politely domestic. It leaks through supply chains, commodities, trade flows, and sentiment. Fe file a site fe turn 48 file 0 fe. Now combine that with the external strategy. A country working to reduce exposure to the dollar gate, while also wrestling with domestic deflation, has tools that can produce pain outside its borders. A meaningful yuan depreciation can export deflation. A weakening bid for treasuries can intensify yield pressure. Strategic patience can outlast democratic impatience. None of that has to happen in one cinematic move. Markets are often cracked by combinations, not singular shocks. Fe felicite fe turn 48 file 0 fe. There is also a technology dimension, and you would be foolish to ignore it. This is not just about shipping containers and soybean headlines. It is about chips, rare earths, machine tools, software stacks, and the weaponization of interdependence. Once countries stop treating efficiency as the only goal and start treating dependence as a vulnerability, costs rise permanently. Domestic redundancy sounds patriotic. It is also inflationary. Forced supply chain duplication sounds strategic. It is also margin pressure. Fe falicite fe turn 48 file 0 fe. In other words, the world that helped suppress costs and flatter multiples is not quietly waiting for a comeback. Parts of it are being dismantled in public. You should not need much imagination to see the problem. A world with weaker globalization, structurally larger deficits, more strategic hoarding, more commodity sensitivity, and a Federal Reserve with less elegant freedom is not a world that deserves the same careless valuation habits people learned in the liquidity carnival. But human beings hate giving up a regime that made them feel clever. That is where the real psychological trap lives. You do not just own assets, you own a story about yourself. You own the story that America always figures it out. You own the story that every dip is a gift. You own the story that cash is for cowards, gold is for cranks, and leverage is how serious people get rich. You own the story that globalization may wobble but never truly reverse. You own the story that the Fed remains omnipotent. Then reality starts to ask for payment. I have seen this before, not in identical costume because history is too creative for that, but in emotional structure. In 1999, smart people told themselves valuation no longer mattered. In 2006, smart people told themselves housing could not fall nationally and securitization had dispersed risk so well that system-wide trouble was almost an antique concept. Smart people can be wrong for a long time because the regime that made them smart trained them to misread the next one. That is why I care so much about mental models. If your model still assumes 30 years of dollar supremacy, near automatic foreign demand, low consequence deficits, and a Fed that can rescue without cost, then your model is not just old, it is dangerous. Fe file a site, fe turn 48, file 0 fe. The investor who survives regime change is not the one who predicts every quarter perfectly. It is the one who recognizes when the gate itself is being redesigned. So let me tell you what I would watch if I were trying to determine whether the next stage is arriving. First, I would watch credit insurance. When investment-grade CDs starts moving in a way that cannot be explained away as ordinary rate noise, sophisticated credit money is telling you it smells deterioration before equity investors admit it. Second, I would watch Treasury auctions, weak bid to cover, soft foreign participation, or obvious indigestion. There matters more than 10,000 hot takes about individual stocks. Third, I would watch the currency lane, especially the yuan and the yen, because that is where strategic pressure and global funding stress can announce themselves before the crowd understands what it is seeing. Fe felicite fe turn 48 file 0 fe. Would also watch something less measurable and often more revealing. I would watch language when management teams start talking about prudence instead of growth. When bankers start praising discipline. When politicians start blaming each other for bond market behavior they cannot control. When market participants shift from bragging about upside to whispering about who still has access. When the public begins to distinguish between price and exit price, that is when the gate story becomes social instead of theoretical. And social recognition is when the move gets faster. Now let me make this personal for you, because I do not write or speak to decorate fear. I speak to force a choice. If you are an ordinary salaried worker, you are more exposed to this than you think. You may say to me, Warren, I do not trade currencies, I do not buy credit default swaps, I do not even own much stock. That does not exempt you. If your employer is leveraged, if your retirement account is crowded into expensive passive exposure, if your future house purchase depends on lower rates, If your spending depends on wealth effect confidence, then the gate already owns you. That is the employee trap in a tightening liquidity regime. You imagine you are standing outside the market because you are not day trading. In reality, your income, expenses, savings, and future optionality are all attached to valuations set by people far above your pay grade. That is why I respect optionality so much. Cash, when used intelligently, is not laziness. It is refusal power. It is the ability to say no when assets are still overpriced and yes when desperation finally delivers terms. Gold, when used soberly, is not a religion. It is gate-independent collateral. Conservative balance sheets are not cowardice. They are armor. Lower leverage is not a failure of ambition. It is the price you pay for surviving long enough to buy when others are forced to sell. You do not need to imitate every tactical view in the source material to understand the principle. The principle is larger than the trade list in a world where the dollar gate is being pressured. The first duty is not excitement, it is resilience. That means you stop worshiping total exposure as if bravery itself creates return. You stop confusing permanent dependence on favorable liquidity. With investment skill, you ask which assets require the gate to remain wide open and which assets retain dignity when the room gets crowded. It also means you separate short-term panic behavior from long-term structural change. In a true risk-off episode, the dollar can still catch a bid precisely because frightened people run to the deepest existing lane before they think about the 10-year consequences. That does not erase the long-term erosion story. It complicates the path. Mature investors can hold two truths at once. Panic can strengthen the old gate, even while the long structure beneath it is weakening. Faithful site Fayturn 48 file 0 Fay. Most amateurs fail because they need every story to be morally simple. Real markets are not simple. They are layered. The short term can move in the opposite direction of the long term. Gold can make sense because trust is deteriorating. Cash can make sense because dislocation creates bargains. Selective dollar strength can make sense because panic seeks depth, even while the structural argument against dollar hegemony grows louder. Asymmetric positioning exists because the world does not hand you one clean line. Fayfilicite Fayturn 48 file 0 Fay. But let me come back to the central metaphor because I do not want you to lose it. Everything in your financial life depends on gates. There is the savings gate. Can your money hold purchasing power? There is the credit gate. Can debt be rolled without punishment? There is the labor gate. Can businesses keep hiring when money gets dearer? There is the valuation gate. Can assets still justify prices when the discount rate changes? There is the policy gate. Can the Fed rescue without burning credibility? There is the geopolitical gate. Can reserves, payments, and trade flow through a system that rivals no longer trust? When all those gates are friendly, foolish people look brilliant. When even a few of them harden, brilliance gets audited. That is why I do not want you hypnotized by the soft landing language, the clean consensus language, the language of managed risk. Consensus is usually loudest when regime change is far enough advanced to matter and still early enough for most people to deny it. The market has an old habit of treating structural warning as background noise until the moment it becomes price. Then price becomes morality overnight. The same people who told you risk was imaginary tell you caution was obvious. The same system that rewarded complacency punishes it and then pretends the signs were clear. They usually were. People simply preferred comfort to clarity. You need to choose which tribe you belong to. Do you belong to the tribe that waits for the all-clear signal? That tribe nearly always pays retail. It buys comfort late and sells fear cheap. It mistakes social permission for wisdom. It wants a polished narrative from television, a reassuring phrase from the Fed, a friendly chart from the last cycle, and a public reason not to think too hard. Or do you belong to the tribe that respects gates? That tribe asks harder questions earlier. It notices who is building alternative pipes while the crowd still praises the old plumbing. It watches credit instead of slogans. It studies refinancing walls instead of influencer optimism. It looks at fiscal arithmetic without sentimentality. It respects that geopolitical power and financial architecture are welded together. It knows complacency is not a low-stress lifestyle. It is deferred humiliation. I cannot tell you the exact month a crack becomes a cascade. I cannot tell you whether the visible disorder is 30% or 50%. The market does not reward fake precision, and I have no interest in selling it to you. What I can tell you is that when a system shows large structural vulnerability and prices still behave as if the vulnerability is minor, you are not looking at safety. You are looking at underpriced danger. Fay Falicite Fay Turn 48 File 0 Fay. The ordinary person hears that and wants a checklist. I will give you something better. A test. Ask yourself which part of your financial life depends on the old gate staying open forever. Does your lifestyle depend on refinancing staying cheap? Does your retirement plan depend on multiples staying generous? Does your emotional stability depend on the Fed always being able to ease without consequence? Does your sense of security depend on holding assets that are liquid only as long as everybody else remains calm? Does your portfolio have any exposure to things with value outside political promises and crowded exits? Do you even know how much optionality you own? Most people hate those questions because they expose a painful truth. What feels diversified is often just multiple claims on the same gate. A stock portfolio dependent on low rates, a house dependent on cheap mortgages, a job dependent on easy credit, a pension dependent on asset inflation, a bank balance dependent on currency purchasing power. That is not true diversification. That is concentration wearing different costumes. Real strategic thinking begins when you stop counting wrappers and start identifying dependence. This is where freedom enters the story. Freedom is not a mood. Freedom is not a social media slogan. Freedom is the degree to which a closing gate can change your behavior. If a tighter money world can force you to sell what you should hold, work where you should leave, borrow when you should wait, or panic when you should think, then you are not free. You are gate dependent. I have spent a lifetime trying to reduce dependence. That is all rational capital allocation is at the deepest level. Buy yourself more time, more patience, more refusal power, more ability to survive without begging the system to stay easy. A person with low leverage, meaningful liquidity, disciplined expenses, and a mind trained to think independently may not look glamorous in the late stage of a bubble. That person looks almost unfairly strong when the gates start rationing access. That is why I always come back to temperament. The investor who does well in a regime shift is not usually the loudest one. It is the one who can endure discomfort before the crowd validates caution, who can hold cash without self-contempt, who can own hard assets without needing applause, who can demand valuation discipline when the room still thinks discipline is old-fashioned, and who can think about structural risk without turning fear into theater. You do not need panic. Panic is what people feel when they realize too late that they never understood the gate. You need seriousness. Seriousness means doing the work before the room gets crowded. Seriousness means recognizing that what China has triggered is not a temporary diplomatic quarrel, but a multi-year challenge to the financial architecture that has underwritten American abundance and American valuation habits. Seriousness means admitting that America's internal imbalances make that challenge more dangerous, not less. Seriousness means respecting that the 26th of may not give you one cinematic collapse, but a sequence of pressure events that teach the same lesson in installments. Fay Falicite, Fay Turn 48 File 0 Fay, and seriousness means understanding one final truth. The gate does not care about your opinions. It does not care that you worked hard, believed in the long term, trusted the experts, bought the dip, loved your country, or thought the old framework had to keep working because it had worked for 30 years. Systems do not reward loyalty to outdated assumptions. They reward accurate adaptation. So here is the final choice. You can keep behaving like a tourist in a financial empire that is slowly being redesigned under your feet. You can keep outsourcing judgment to the consensus, keep worshiping the old rescue scripts, keep calling every warning excessive, and keep standing in the same crowded room telling yourself there is no need to look for the exit because there has always been an exit before. Or you can start acting like an owner of your own capital. An owner studies gates. An owner notices when reserves are being moved, when foreign trust is thinning, when debt supply is outrunning easy demand, when refinancing math is turning predatory, when technology interdependence becomes economic warfare, when policymakers are trapped between inflation and rescue, and when the comfort of the crowd itself becomes a liability. An owner builds optionality before the scramble. An owner respects liquidity before needing it. An owner would rather look early and foolish than late and trapped. If you understand that, then this is not just a macro story about China, America, gold, yields, or 2026. It is a personal test. When the gate starts to narrow, will you be one more person discovering too late that your wealth, your job, your confidence, and your freedom were all rented from a system you never bothered to study? Or will you be one of the few who saw the hinges moving, stepped back while there was still room, and made sure that when the crowd finally reached the door, you were not standing there begging for it to open? That choice is coming whether you feel ready for it or not. The only question is whether you will make it while the gate is still wide enough to matter.